Hey everyone, Jeremy Portnoff here, back again for another market update video. As always, the purpose of this video is to provide you with a general update of some of the recent developments in financial markets, give you a sense of where we're at, what's happening, some of my thoughts. And I'm going to do an update later on the tactical portfolio here in the second half of the video. So before we begin, let's take the quick look at that disclaimer. Go ahead and pause to read. Just remember that it's really important to understand everybody's situation is different, and so you should consult with a qualified financial professional to assess how this information may or may not apply to your individual situation. If you'd like to discuss how any of this information may impact your plan, you'll be able to schedule a call with me by clicking on the link at the end of the video. Alright, well, the first thing that I want to talk about, when we talk about looking at markets and you know, what I wanted to bring up is something I suggested or otherwise might have assumed would happen actually happens. I just want to be clear that it didn't mean I knew it was going to happen. Obviously, rather, you know, make an educated guess based on analysis of whatever it was that I was looking at. And that's what we do in this business. We look at charts, patterns, trends, etc., and really based upon prior outcomes of similar events, we make educated guesses or assumptions about what might happen or could happen. It's great when we're right, but many times we're not. And when we're not right, we revisit the chart. We look again, we update our analysis and our decision criteria. So this might be happening right now, depending upon what happens this week, because it looks like the market has stalled out just right around the point that I suggested it might. And for the reasons that I've said, if you want to go back to one of the videos last week and get an update on that, you know, you're more than welcome to. But let's take a look at that, and then we're going to look at some of the portfolio positions that I'm looking to re-enter but haven't quite yet, because several, you know, I'm really kind of teetering on the edge here with some of these, and you'll see why here in a minute. But what I want to do is I want to take a look at this trade tracker. It's like a training module in this software, if you will. It's really cool because it allows us to kind of look back and then advance forward day by day, once at a time, just to get a sense of how things are developing. It's just a really interesting view on what has happened so far, and really just kind of to help make the case for what it is that I'm looking at. So on the screen here, we can see that green triangle pattern that I showed a number of weeks back. We see this point here in around June here where the market kind of stalled out. We got that dip, and then we got that low that occurred on June 16th. So we see the bounce that has happened since then. We've got this triangle pattern developing, right? So it kind of bounces up, it retraces, bounces again, touches that line again. Then we got another, touches the lower trend line here. So let's go ahead and look at this and advance forward one day at a time. Okay, so we see it goes up. We see a next day it kind of was up, but it traded down. That's actually the day I believe I originally drew this pattern, because it kind of just touched that upper trend line again. Well, the next day we got that breakthrough, right? It broke through to the upside, and then the next couple days you'll see another up bar, right? So it's looking like this thing broke out of this pattern. So far so good. But then we get a down day, right? So it doesn't advance any further. We get a day that was technically up, but within the lower end of that prior bar. Let's go ahead and zoom in a little bit there. Okay. Then we get the down day, right? So it's like, okay, is this a false breakout? What's happening? And you get a nice solid up day. So we got a retracement. It stayed above that pattern. It started to go up. This is looking like at this point that bottom is confirmed. The breakout of this pattern is confirmed, right? But we still have our eyes on this resistance level, and you'll see I drew that line right there for easy viewing. All right, so now we got an up day after that, another solid up day after that. Gets right up to that level now, where we're seeing resistance, right? The next day, down day. So it's really important to look at these candles, because we can see it was technically an up day, meaning that the close was higher than the open, but it occurred within the whole prior day's movement, right? All right, so now we got another down day. So we hit that resistance, market starts to back off. Now what's interesting is you can see even with 2 down days, that moving average right there is still going up. That's the weird thing about moving averages, because they're on a lag. So that's why we got to be careful of that. All right, well now if we got to follow through, we got another up day. but it's still right there at that level. And then we get the next day, which, let's see, I think that was Thursday, last Thursday. So again, technically a down day. The overall close and the open were around the same point, and they were kind of the top of that bar. Usually that's kind of a bullish signal. But then in this case, on Friday, it was interesting because the market opened much lower. It actually closed higher, but the overall close was lower than the prior day. So you can see what I'm seeing here. Even though this is technically still rising, it's not rising much, right? It's still within the pattern of that 1 week's movement. And even if we take a look at a weekly bar there, right, we can see we had that, see that bar with that real long lower shadow, right? And then we get the up bar, strong up bar, then we got a shorter up bar for the week, right at that resistance level. So I'm skeptical. This is why we look at these kind of charts and these patterns to see what's going on, and then just to kind of follow through. So this was today, and so we get this pattern here, this particular candle where it opened up, and it was at the high end of that prior couple days range. It's right around that resistance level, and I'm thinking, okay, you know what? It might be time to start getting back in. And you can see how it traded up with that, what we call the shadow, that little line there. I don't know if you guys can see that, but it actually traded above the level of that resistance level, just very briefly, and then all the bears pushed it right back down, and it ended up closing lower than it closed the prior day, right? So making it a down day. This kind of pattern, it could be what we call an evening star, which tends to mark tops. Basically what's happening is it's trading up, and then the bears are pushing it right back down. And you're seeing that in the course of this week. We had two days like that. The market just kind of doesn't want to go above this level. It's hitting that resistance there. It's like right on target there, right at that level. So I am super skeptical. That's why I'm just waiting this out, because these bear market rallies love to suck you in. And so I think we can afford to wait a little bit, because I'd really rather see some confirmation of breaking above this resistance level from back in June. All right, let's turn off this. Oops. Can't turn that off there. So let's move that out there. Okay, hang on, guys. Sorry. Oh, thing's in the way. There we go. Okay. It's not letting me move. There we go. Okay. So that's where we're at on the S&P. We're hanging around right at that level, and I think what we need to consider is that there's a lot of trading going on that's pushing it down. But if we get a break above that level, you might start to see a surge, and that I think would be the time to really get back in for aggressive investors. So that's what I'm looking for. When we look at small caps have actually had a nice run. We have a similar resistance level from June, and you can actually see we broke above. But that candle pattern there that I was talking about, that's what we call a possible evening star. What happened is you have a strong up day the prior day. It gapped up, right? So meaning the open was much higher than the prior day's close. So we call that a gap. And then it traded even higher, but then came back down. So technically it was an up day, right? We also tend to see these things at the end of a strong movement, like that final, frothy top, where it kind of loses that power and comes back down. So it's really going to be, tomorrow will be indicative of you really confirming if that's the pattern that's happening. And so that's something that I am looking for. Nothing too exciting going on in the bond market there. We're just kind of hovering around that same level. We've had some pretty big movements in the last week or so, but still nothing too exciting there. If we look at volatility, let's go over to my other chart here, and if we look at the whoops, I got logged out. Okay, let's try again. I think that's the wrong page. There we go. Didn't get logged out. All right, if we look at volatility, we can see that the VIX, which is a measure of implied volatility, has really generally been trending down, and that's why we're kind of seeing that rally. A little tick up today, nothing major. What I found interesting is the put-call ratio, which measures, the amount of put options which are bearish versus call options which are bullish. That has also been dropping and is a pretty good amount below the level. Typically 1 is where it's going to be, right? So that's actually a really kind of a good sign there. I like that potential bullishness. Now let's go back to the S&P for a second. Let's hide the volume. Let's hide that triangle there. Okay. So that RSI indicator, which is that relative strength I mentioned before, normally 70 to 80 is the overbought, but in the context of a bear market, we see that overbought level usually a little bit lower, so that's kind of backing off a little bit as well. Our trend indicator, this ADX line, we see that green line, which is the number of up days, is actually declining, right? So that's again, it gives us a sense that we're losing steam there on this rally here. But I wanted to look at the breadth. So this is we've got the purple line down here, which is the percent of stocks above their 200-day moving average, and the green is the percent of stocks in the S&P that are above the 50-day. So you can see it hit that high. It's actually been trending down a little bit, so we're not getting as much participation. But more importantly, we haven't seen the number of stocks above the 200-day rising very much. It's kind of also remained in this pattern. So again, while you see the major indice, the S&P kind of technically still rising a little bit, it looks like it's starting to top out there, but the overall percentage of stocks are not going up above those averages. Again, another sign that this rally is looking a little bit tired. Again, we'll have to wait and see what happens tomorrow, but it's like I said, it's right on the edge there, where we might consider getting back in. Yeah. So once we start to see, I think, a little bit more full participation in some of these things, then I think we can be a little bit more optimistic. But for now, I'm still a little bit skeptical. So now, when we talk about the idea of recession, and I actually created another video showing the stock market in the context of recessions, and that link should be in the email that's going to go out with this video. So I encourage you to watch that. This is that yield curve, and I was able to overlay in the shaded gray bars the recessions, right? And so you can see it's kind of that repetitive pattern. This yield curve, which is the 10-year Treasury minus the 2-year, once it inverts, which is when it goes below this center line here, it inverts. You tend to see recession, within a year or so after that. And it's a very repetitive cycle, it seems to be. And we can see where we're at now. Zoom in a little bit. Remember, it is inverted, right? So we got news of second quarter GDP being negative. There's a lot of argument going on in the financial community and the political world about, well, is this a recession or is it not? The arbiter of recessions is the National Bureau of Economic Research. They're the ones that get to put the label on it. And so anyways, I created a video that kind of showed the stock market in the context of recessions. Some pretty interesting views to get from that. So again, I would encourage you to watch it. But I thought I'd add a few charts here just to give you a sense of some of these things. So this is the real GDP chart. And we can see as those shaded lines are the recessions. You see that GDP number dips when there's recessions, right? I mean, it's really not surprising. And so when we zoom in here, we do see it dipping, right? And so we just don't have the label yet. Now, some of the things that get pointed to are like the unemployment rate, which we see here. Unemployment rate is very low right now, and you'd say, well, how can we get a recession if the unemployment rate is low? This is one of those things that we need to be really careful of because a lot of people who are not familiar with economics, they point to things like this and say, unemployment's low, this is great, right? We need to peel back the layers of the onion a little bit there because one of the things I've said before, I'll say it again, we have an increasing numbers of baby boomers that are retiring. They're leaving the workforce and they are no longer being counted. And so as that continues to happen, there's not as many of the younger generation coming into the workforce. And so with fewer people being counted, it may make the unemployment rate look artificially low. So it's just something to kind of be aware of when you're hearing about economic numbers. Now, what I pointed to more recently is the initial claims for unemployment, and on this chart you see it kind of rising. There are other times, like you go back the last couple of recessions, right? There's the 2008. You would see that rising before that recession, right? Back here before 2000, right? Same kind of thing. So we're seeing it happen again. Now, I think if I just pull this back, though, something to notice is that while it's rising, it's still relatively low. So that's kind of, I think, still a good sign, but it's a potential indicator. Non-farm payrolls, this is just payrolls. This is money. And same kind of thing. You see that payrolls tend to drop with recessions, right? It's very clear in the last couple, right? Very, very clear. We're not seeing that just yet, right? So that's one of the reasons why some people are arguing there isn't a recession, because payrolls are up. Now, you can actually see the rate of ascent there is slower, so we could see a dip in coming in the future. But anything is possible there. So whether this ends up getting labeled a recession or not, remains to be seen. Now, I came across a chart from somebody else I thought was really interesting, so I wanted to share. What this is a ratio chart, a relative index comparing the Treasury Inflation Protected Securities Bond Fund versus just a regular intermediate term Treasury bond fund. And the idea here is for inflation expectations. And so when that number is, the ratio, when the TIPS funds are going up more than treasuries, that tends to indicate the expectation for inflation. If this is in fact the case, you would see that we peaked out here back in April, and it's been dropping since then. So does that mean the expectation for inflation is dropping? Maybe. As a potential leading indicator, this would be pretty interesting. So again, something we want to keep our eyes on. So, all right, let's go ahead and look at some of those portfolio positions. All right, here we go. So this is the portfolio list, and we can see. I know these fonts are real small for you guys watching this, but we're looking at just kind of general trends. And we can see still the 200-day moving average is still pretty low. Most of these positions are below it. We're seeing more of the intermediate term averages and the 10-day being over the 65-day. We're seeing more of those go above the other, but we have seen some of the shorter term averages kind of dropping back below the others. Another kind of just general sign possibly could be topping out. Alright, so earlier in the video I was mentioning this candlestick pattern called an evening star. Really what we're looking at, when we look at these candlestick patterns, right, we're looking at, where was the open, where was the close, and the high versus the low. And you can see the body of the candle of what happened today, right? Just like on the S&P chart, you can see price, this is, we're looking at large cap value here. Actually, that's out of order. Hang on a sec. Let's just move that back. There we go. Large cap growth. So growth stocks, you can see, have really led the rally. They've actually exceeded that resistance level, and so kind of that criteria has been met to get back in. But again, for other reasons previously stated, I've decided to just kind of wait it out, and you kind of see why in a little bit. But this has popped over the moving averages, but you can kind of see again, it looks like it might be stalling out here. It actually traded down today, but it opened up, traded higher, and then came down, right? So that means there's a lot of bearishness. I'm a little bit concerned there, but if we can pop over some of these averages, I think it'll be time to get back in. All right, so large cap value. Again, value stocks never went down as much. They haven't come back up as much either, but we can see it's value stocks that are really stalling here. So it puts pressure on the overall blended index. But again, we see that large cap growth rather, has really led that trend, whereas value stocks, large value, have kind of paused here, right? So when we look at some of those other categories, similar here, we've got mid-cap growth. So mid-cap growth came right up to that same resistance level, kind of just hung around that level again. And then today, right, we see that gap up, and we see that long upper shadow traded back down, right? So again, technically an up day, but that is a sign of the end of a trend. Tomorrow will confirm it. So if the pattern holds, then I'm going to wait. If it breaks above, then it could just be a midterm gap, and we could see some good potential going there. So could be time. Again, I'm just going to give it that additional day or so to wait. Mid cap value, same thing. So we got stalled price that didn't get anywhere near that prior level, but we have that same pattern, that same gap, right? So again, that's why you don't see full participation in all of these asset classes. Small cap growth, we do see that it has exceeded like large cap growth, but same pattern there. Got a nice solid run here, but we got that long upper shadow there on that bar today, on that candle today. So we'll see what happens tomorrow. Small cap value. So is actually with today's movement trading above where I exited just by a smidge, just like it did last week, right? So same thing. Didn't quite get up to that prior resistance level before you see it consolidating around this. We got that gap up today. Same pattern. Again, it just doesn't feel good. We got micro cap stocks, which are only in the more aggressive portfolios. Very similar to small growth, right? It exceeded that resistance level there, has popped above. We got that same spike happening up there. So again, it looks good, but it's just, bear markets love to trick you. So I'm of the opinion, given how much things have dropped, given this is happening in the context of a bear market, I believe that we can afford to wait, right? So again, Tuesday will really be very, very telling, I think, in terms of, if it can stay at that level or even go higher, I think that's a really, really good sign. That'll also mean on the S&P chart that we're exceeding that resistance level around that near 4,200. So, all eyes are on that. So now when we look at the international stocks, not such a rosy picture, right? Again, we've hit resistance. It's backing off this past week. Didn't get anywhere close to the level. So we have another lower high. So that's foreign large growth. Foreign large value, same thing. Backed off. Didn't get back up anywhere near those prior levels. Even here, this little minor bounce here kind of hit that resistance, stayed. We got that gap again today, but it's trading downward. Foreign small cap, right? Same thing. It's all the same thing. It's just consolidating right around this past week. Emerging markets, right? A little bit of a bounce, still staying around that level. Real estate, same thing. Consolidating right around that level. Same at that resistance level. It's just kind of like, it's repeating over and over again. International real estate not doing quite as well, but same thing. Backing off from that a week ago. Preferred stocks seem to be backing off a little bit. Haven't gotten into those yet, but I'm seriously considering it. Same thing with variable preferreds. We're seeing some downward in the last couple of days. Gold has been on the move, but it's still, when you put it in context, it's had a nice little rally, but it's still well below levels I would consider getting back in. Or getting in. Wasn't in before. Commodities have just been consolidating around this level, again, for really several weeks now, right? Not really moving anywhere. It's very possible that commodities peak is over. Another commodities fund just works a little bit different way. Same kind of thing. Backed off last week. Had a strong, solid day on Friday and kind of continued, but with that same spike, gap and a spike. So I'm not too optimistic there. Short-term bonds, same thing. They've been moving down this past week. Aggregate bonds, same thing, moving down a little bit, not much there. Junk bonds, which kind of trade more, they behave a little bit more like stocks, at least in the pattern. Kind of seeing that same thing, right? Seeing a rally, nice rally. Couldn't quite get up to that prior level. And then we see that high upper shadow there today. So again, I'm kind of skeptical. That's about ready to get back in, but if it bumps down from there, I'm going to continue to wait. Inflation bonds have been going down a little bit. Again, get a positive day today, but in the context of the last week or so, still down. International bonds, trending down. Emerging market bonds, a little bit of an uptrend actually there. But, again, when we put that into context, it's still right around kind of that prior level of resistance. So, yeah, I'm trying to be optimistic, but I'm just looking at the charts and I'm just expecting that we're going to get faked out here by the markets. When you put some of those economic things into context, it just gives a little bit of pause. But we're going to let the charts tell us what to do. I think in the next couple of days, I hope that we get a little bit more clarity, because I think that just kind of summarizing all of this, it's really a mixed bag right now. So, but again, I mentioned I created another video looking at the stock market as it relates to recessions, and so it's really important to understand that the stock market does not always coincide with the economic news. So please check that out. I think that would be very, very enlightening and helpful as we try to navigate through this really, really difficult time. So be on the lookout. I'll see when I can update, maybe another week or so, and we'll see how things go. So, all right, well, thanks so much for listening. Let me know if you have any questions. Again, there'll be a link at the end of the video here to schedule a call with me, or you'll have my email. You can respond there. Either way works for me. All right, thanks again. Take care.